Hi, my name is Molly Abdoli, and today we're having a deep conversation with Luda Beanland, a chartered tax advisor and a co-founder of Longview Wealth Partners.
Hi, Molly. Thank you very much for organizing.
Thank you for coming.
for
I
having
have so many questions. Oh my goodness.
I love the questions. Please
Yes.
go ahead. Yeah.
So let's start with why is January such an important month for high net worth individuals in the UK tax system?
Right. So it is important to remember that January is a deadline for self-assessment tax returns, and specifically 31st January. So normally it is very, very busy time for the accountants, for tax advisors, and for the clients.
Do high net worth individuals need special tax advice?
Well, high net worth individual is, first of all, there are various definitions who actually high net worth individual is. But generally, someone, okay, say they accumulated the wealth. So we are not going into thresholds because they're different for various institutions. But generally, I would say if someone's got income more than 150,000 a year, in any case, I would recommend they take tax advice because they would probably need to file their tax return. There could be whether they're employed or self-employed or got interest, dividend, and so on and so forth. I would recommend to take tax advice if your income generally is more than 150,000.
So, according to HMRC, thousands of UK taxpayers overpay through payments on account every year. So, can high net worth individuals still review or reduce their UK tax before the 31st of January?
Yeah, that's a very good question. And in reality, we see lots of, by filing self-assessment tax return next year, when we review, we see a lot of refunds going on. And HMRC normally owe the taxpayer money when taxpayer overpays, and that normally via payment on account. So first of all, what payment on account is? Payment on account, HMRC, when we do your tax return, we calculate tax liability. Not only you have to pay your tax liability on the 1st of January, but you also have to pay 50% in addition to your tax liability of that amount. For example, if we have figured out that your tax liability is £1,000, you have to pay 1,500. So 500 in addition to your loan, and then additional 500 on the 31st July. So that's what payment on account is. Now, what happens when 1 year, say you earned, let's talk about small numbers so we understand, £1,500. However, so you have been paying £750 in addition in January and July. However, next year, instead of earning what you were expecting, similar 1,500, you earned, say, £1,000. That means that you have overpaid payment on account, and HMRC will owe you some money. So these are just small numbers, but there are some which might result in many tens of thousands or even millions in overpayments. So therefore, when we work with a client, we normally do ask about not just filing the return and talking about compliance. We would normally talk to them about what their circumstances are now. Has it been a good year for them? Maybe what the changes they have experienced in the current year, and if there is a reduction in certain source of income, we would reflect that in the tax return, and we would make what's called reduced payment on account. So the payments which client pay in advance would reflect their financial situation rather than paying HMRC what sort of what on the paper.
And which months would you recommend high net worth individuals to come to you and review all these? Because January is too tight, right?
Yeah. So I would say January would be, okay, if there is no option, January is still an option. So, but I would say the good time is as soon as possible. I wouldn't advise to leave it. Probably if you want them like quite a lot of attention from your accountant, probably February, March, April would be the best, because that would be quiet for personal tax season, and probably your accountant would have all the time in the world to look into your situation and see where they can help you. So probably that's the best time. However, I would say anytime, anytime rather than January.
So let's assume that the tax is in millions, and your client is saying that they don't have this money and they can't pay. What happens?
Yeah. So normally HMRC has a facility which is called time to pay. And what's that about? If there is a tax bill to pay, HMRC's got a department where you can call and you can, as a taxpayer, you can discuss how you can you pay your tax liability in installments. And but be prepared. They will ask you what your income is. They will ask you all your what your bills are, monthly bills are, and you have to really call them when you are prepared. And then they will ask you what amount you're thinking of paying and how much money you're going to pay as you speak, immediately, because they want to see a chunk of money covering maybe 25 at least percent of your tax liability are right there. So that's something you would have to discuss with them. But it's a very good way of actually managing your cash flow if everything else fails. They will ask you whether you have tried, by the way, to arrange a personal loan with a bank, and that's something you would also have to answer to them.
Okay. And they have to call. Accountants cannot call for them.
Exactly. Yeah. So you normally advisor wouldn't be able to call, so you have to call.
Yes. So interestingly, HMRC agreed £7 billion in time to pay arrangements in recent years.
Exactly.
So if you are struggling, try your luck. Don't give up.
Yeah. So if you have a cash flow problem, exactly, and maybe you've tried the bank. I mean, I would say try other sources before call HMRC, because that's a question they will definitely ask you. Have you tried to raise money elsewhere? And keep it as a proof, because you might be asked to send it to them. Yes.
Okay. How does having multiple income streams, property, dividends, businesses, overseas income, change UK tax planning for wealthy individuals?
Right. So first of all, when we see a complex situation with quite a few streams of income in the family, then we would want to know perhaps a little bit more about the family, who does what. We would like to speak about goals and ambitions for this. If it is a business owner, say one of the sources is a dividends, for example, or salary, or are there any family members who participate in a certain things or business or ownership. So we would try to understand the situation where client currently is and what they're planning to do, and then we will provide discuss and agree tax structure for the client to minimize tax liability.
Thank you.
A pleasure.
So, what are the most common UK tax structure mistakes you see among wealthy individuals, and who built without a long-term planning?
Yeah, I would say lack of communication with your accountant, and as a result, your accounting, filing your tax returns, doing compliance without knowing much about you or about your family or about your financial situation. I think that is a lack of communication between two is probably the most common. So as long as a taxpayer has got a qualified tax advisor or accountant, then the next one probably is lack of communication, and that lack of communication could be down to a normal business of our lives, which we always, for example, in our accounting practice, Longview Wealth Partners, we have a mentoring support which we offer our clients on a monthly basis, and clients can opt in into that support and see your accountant every month and discuss issues which probably they didn't know they had, or if something is in the mind and something troubles them, they can discuss then.
And I think, I mean, private clients are very discreet and they do not want to tell other people everything about their assets, about income streams, and that's what they have to find. Yeah.
Absolutely. And one of the things you've got to feel comfortable with your account. It's like being comfortable with your doctor.
Yes.
You really got to like them before you tell them about anything at all. You have to trust them, and I think that's where when you try to choose your accountant, you probably look do I like this person? Is it someone I can chat about my life? Because lots of things come from just chatting randomly, about your family, about your affairs, and that will give a very good kind of overview of your family when you tell them probably a bit more than you would tell your friend in the pub. So provide with all information account needs to provide you with the right tax structure.
Yes, and also I think there is a difficult question people don't want to talk about is inheritance tax.
Oh yes,
because they don't want to even think about dying soon, and accountant is a person who has to raise this question. What do you think about that?
So I think first thing which probably I would, when somebody start talking about inheritance, my first question would be, do you have a will? And if somebody doesn't say no, then we would probably point out that they probably should have. And there are solicitors, lawyers who can help with that. Second thing is talk about inheritance tax bill, which is currently actually 40%. I mean, if you the rate is very high.
Yes.
So depending on the will, then we would ask what's in your will, and normally clients are happy to share. We will see where we can do the tax, or before somebody writes a will, we would if they I want to leave this and this exactly advice, we would talk to them whether what they have planned is a tax efficient way before they write a will. So depending on what stage client comes, maybe already have a will, we would advise on the best structure. So it is possible to structure in such way to minimize your tax liability. It is possible, and not always 100%, but we would always use all the ways which legislation provides for reducing tax liability.
Yes, but because inheritance tax one first is very high, it's 40%, and second, if someone is taken by surprise and they inherited the property, let's say for £1 million, or 10 million. Okay, let's say £1 million is for to make it easy. They have to pay 400,000 tax first before being able to have this property and being able to sell it, for example, to find this for 400,000.
Well, depending whether they, I mean, there are still allowances available for so we would have a look in absence of any allowances. That's exactly they would have to find 400,000 for and we know clients who whose relatives because of their old age did not want to think about death. They did not want to think about wealth. So after they have passed away, their relatives had to sell in order to pay their tax liabilities. They had to sell a few properties. That's something an individual who died, the deceased one was so keen on building up, property portfolio, carefully chosen. Unfortunately, when they died, they had to just sell them just like that, and that's quite devastating. That what could have been just simple tax planning, probably a couple of £1,000 sorting out the tax issues, they ended up selling properties so they would be able to afford that tax bill. So I think good planning definitely would everyone would benefit from a proper planning.
So, why do wealth structures often become outdated after 5-7 years if they were not reviewed regularly?
Exactly. So with the legislation changing constantly, I would even recommend clients take tax advice every year. Because actually, to be fair to our clients, they do request update them on changes, and they do take tax advice every year. But considering that legislation changes may change twice a year, even not even once, I would urge anyone to take tax advice, at least once a year. I'll give you an example. We still have clients who come to us and they'll ask us if they can register their business abroad and manages from the UK, or buy an asset but to register company, say somewhere in Belize. We're saying, hang on, that used to be, we are talking about 15 years ago. That was probably 15 year was a fashion, then to reduce your inheritance tax bill. There used to be a variety of other benefits doing that. Nowadays, probably people do opposite. They come to us and say, well, how can I actually undevelop, my, say, property which they bought 15 years ago from offshore company. So it just shows that if you are not keeping sort of like with your tax affairs, you would probably fall for something that was sort of in fashion 15 years ago, but not outdated as we speak.
Yes, because the compliance is changing. Yes,
all the time. Yeah, all the time.
So speaking of offshores, HMRC estimates 10 billion plus annually relates to offshore and cross-border non-compliance. So the question is, let's talk about international clients now. What are the biggest UK tax mistakes international clients make around residency and overseas income?
Right. So let's speak about residency. Clients, quite a few advisors, those ones mainly who do not understand the all nitty-gritty sort of legislation, and clients themselves think if they spend in the UK less than half a year, than 6 months, they're not tax residents, which is absolutely not true. So I think when we see clients who, some of them actually, to be fair to them, they have taken tax advice and they were advised incorrectly, saying that they were not tax residents, only to be shocked that they are tax residents. And what that means, they have to pay tax generally on default on a worldwide income. What it used to be up to this April. Now we've got some benefits, like first 4 years you don't pay tax on your income abroad. Okay, we had that, but it still comes a shock to the clients. For example, they have to pay tax on the UK source, or say dividends or interest, but if they were not tax residents, they wouldn't have to. So first, I think that kind of misconception of residency rules. In terms of overseas income non-compliance, it depending when actually you have arrived in UK. Because after this April, we used to have what's called remittance basis legislation, which allowed you, provided you don't use income you earned abroad while you were again resident, you didn't have to pay tax on it. Now, from this April, we have 4 years where UK tax resident doesn't have to pay income on sources outside of the UK, provided that those sources are not direct, they're not linking with you working in the UK.
Okay, thank you. So according again to OECD and HMRC cross-border compliance reports, poor advisor coordination is a major cause of double taxation and reporting errors.
Oh yeah.
Here we go. That's why I come to Longview. How should internationally mobile individuals manage UK tax advice alongside overseas advisors?
Yeah. That's a very good question. And we actually have, especially those ones, I would say, we have a lot of expats on innovator visa, talent visa, and these are mobile individuals who come in, and they travel around the world, and they work in different countries. And it is very, very massive area of discussion, could be. So our advice to such individuals that they should take tax advice in every country they work, and not just from a tax advisor, from international tax advisor, they would have a look at double tax agreements and treaties between the countries. So to make sure that an individual doesn't pay taxes in both countries. So if there is an agreement and tax treaty between two countries, normally where that individual works, that's where they pay tax. And we see a lot of our clients, I mean, they become our clients, but initially when we provide them with the tax advice, turn out to be that they were registered, say, in Germany somewhere, and they were paying taxes in Germany where actually they were working from the UK. So instead of paying in Germany, they should have paid tax in the UK or other countries. So we see that all the time. So it is important to take tax advice as in the country you think you should be paying tax and in the country where you work, to see if there is a double tax agreement, to make sure that all compliance is correct and you don't have to pay tax twice.
What typically triggers HMRC inquiries into high net worth or internationally connected individuals?
Generally, well, it's a very good question. We need to remember that there is a system which is called Connect, and HMRC is using it. This system uses elements of artificial intelligence, and what it does, it connects all your income, what you report as a taxpayer in your self-assessment return, with what goes through your bank, with your expenditure. When there is an exchange information as well between countries. Some of them are automatic, some of them are not. And if your income doesn't tally up with your standard of your living and how you live, and the system can identify that via your bank statements, then there is a automatic inquiry. HMRC would review officer and would likely send you an inquiry. I still remember that we had that there is one street in Kensington where it seems like HMRC used to send every single household HMRC inquiry there because the income there did not tally up with expenditure they had. So that was quite interesting observation.
Interesting. So in case of these inquiries, but hopefully we won't have any,
Yes.
how does strong documentation and governance reduce penalties and inquiry risk in the UK?
Yeah. So that's very good question. Provided that there is an appropriate supporting documents, there is everything that taxpayer needed to say is provided, all extra information is provided, what it's called white box. So effectively there is a box in self-assessment return, and sometimes we actually, if there is something that we would raise a question in a tax return, and we think if I were a HMRC officer, I would raise that. So we would put answer straight away in that white box, something that beyond the information we have provided. We would urge our clients. So for example, I'll give you an example. If, for example, you received a gift from your relatives, say X amount of money, and you do spend it in the UK, but obviously your income, and you've got a modest salary, your income would not tally up with your expenditure, and Connect system would highlight it. However, when HMRC would actually send you HMRC inquiry, they would think twice, because in the white box we would actually disclose that you have received a gift during a year which you used to meet your standard of your living. So it is very unlikely that HMRC would actually open up inquiry for you, because we have provided extra information, and we would have explained why your expenditure exceeds your income.
Yes, yes, yes. So correct me if I am wrong about documentation. So for example, if you are buying a property in the UK, yes, for let's say £10 million, you have to provide source of funds.
Yes.
And if you say that, oh, I have this £10 million accumulating on my Swiss bank, then you will have to provide documents for this Swiss bank account.
Yep.
First, you have to provide the documents how you initially like generated the income
Exactly.
which you put into the Swiss
Yeah.
bank.
Yeah.
And if you say that, oh, because I sold another apartment which was only £1 million,
Yeah.
then you will have to provide documentation how
Oh,
you
yeah.
got this £1 million. So that's why keep
It's-
your documents.
It is a little bit painful, exactly. So we had a client who actually wanted to buy a yacht, and his income was deriving from various sources. So to make life easier for the company, which was actually the one he was brokerage company was buying a yacht from. So what we did, we have provided a document verifying that we have verified the following sources of income. So having our paper that we have verified was enough for the client just to provide to the brokerage company to purchase that yacht. Obviously, we have to do our own job. We have to do our own due diligence and make sure that what we verify is correct and true. That's what we do. But it's much less painful if we do it. Someone who already know almost all life story of our client rather than does some stranger who
In the bank.
exactly in the bank or in a brokerage or solicitor or anyone else. Yeah.
Yes, thank you. So that's why keeping your documents is very important.
Absolutely.
So last question is, what does the UK wealth structure look like for someone thinking in generations rather than tax years? Like the first thing that comes to your mind is creating a trust.
Yeah.
What do you think?
So once again, depending on what your goals and ambitions are, and what exactly you need that trust, whether you want to have it offshore or in the UK, and what the trust does for you, is it the protection of your asset, what is the purpose or benefit of the trust, we would have a look at the client. And for example, some of our clients want to minimize HET liability, and the only way now they actually can take insurance. So that's one of the ways they can minimize HET. So depending, by talking about
IHT is inheritance tax.
Exactly,
Yes.
exactly. Thank you. So but when we talk about decades, we know that full well that in the past, for example, having a trust abroad would, for long-term residents in the UK, they would benefit if they not obtained that trust. However, nowadays, since April, unfortunately, that structure doesn't work any longer. So depending what your goals and ambitions, we would have a look at your long-term structure. But unfortunately, we would have to review it every year, because with the tax changes which are happening twice a year, okay, in the UK, it's impossible to provide some kind of assurance. I would say assurance over the long period of time. We can recommend a structure based on the current tax situation. However, my advice always, do renew your tax affairs structures as on ongoing basis every year. See what changes maybe you need to make changes. So therefore, it is very important to have proper tax advisor, tax accountant at hand when you need them.
But okay, how would you suggest to pick the best tax advisor?
Normally, I would have a look. Normally, I would look first one for someone who's qualified, who's got practicing license. Once you make sure they are suitably qualified, you see whether you actually like the person you're going to work. I think for me, personal touch and personal, whether you like that person, because you will have to tell them half of your story life or maybe whole of it, because they would have to, so you would have to feel very comfortable. It's someone who you can have a look and see whether you can trust them. And if it is someone who you can trust, I think that would be, provided they're suitably qualified, that is the way forward.
Yes,
Thank
absolutely.
you.
Thank you so much. And if you have more questions, please ask in the comments, and we'll leave all the information about Longview Wealth Partners below the video. Subscribe, like, and share with your friends.
Thank you very much. Thank
you.
you.
Bye.